from the Crypt.
What is up, freaks? Welcome back to Tales from the Crypt. We had a very special episode today. This is the first ever outdoors edition of Tales from the Crypt. It is a beautiful Tuesday afternoon here in Brooklyn. Decided to record this episode on the roof with my guest. Let's jump right into it. I don't want to keep you freaks waiting any longer. I'd like to introduce you to my guest, Parker Lewis. Parker, welcome to the podcast.
Thanks for having me on. It's been a long time coming.
It's been a very long time coming. We've been having a lot of conversations for many years now, and I'm very excited to finally get one on record. For you freaks that don't know, Parker has a vast knowledge of economics and Fed policy in particular. Former and current advisor to Kyle Bass, correct?
Off the record.
Off the record? All right, we could start over.
No. I'm kidding.
Okay.
Yes.
And currently working at Unchained. That's why he's in town. We were in Tribeca last night. Unchained Capital was unveiling their vault solution, demoing it in person. It was great to see Drew, Joe, Parker, and team showing their product in person. And slight disclaimer, Unchained is obviously a sponsor of this podcast, but Parker is a friend first before a sponsor. So let's jump into what you guys are building at Unchained. That's not going to lie, my co-host on Rabbit Hole Recap is always curious about multi-sig solutions and the products that are available and how individuals interact with them. So how are you guys approaching this, and what are you guys doing that you think is different on the market right now?
Yeah, so again, thanks for having me on. So we're just up here in New York. We officially released our Vaults product about 3 weeks ago at South by Southwest. We're based in Austin, and so we released it at our Austin Bitcoin Developers Meetup that Justin Moen, or goes by Justin Moon on Twitter, hosts, and we host the group there at our office in Austin. So we released it about 3 weeks ago. Really, the idea behind the Vaults platform is when Unchained was co-founded by Joe and Drew, Joe Kelly and Drew Bonsall in 2016, and then they started lending in mid-2017. They were lending their own capital and decided that they weren't going to be willing to outsource that core function of security and custody to a third party such as a Coinbase or a Gemini. And so they really set out at that point in time and committed to it to deliver the best security when loans were outstanding and when they were securing their borrowers' collateral. And over time, when I met them, after I left working in full capacity at the hedge fund I was at in Dallas, I moved back to Austin. We were having conversations about custody, and they had the custody piece that was underlying the loans because it was the most important part of the loans. How do you actually secure collateral? And the more that we had conversations, the more it made sense for them. The ideas that we were talking about was to actually release that product as a standalone service, and that really the core function there would be to deliver people better security, kind of looking at the problem from the perspective of in the actual institutional piece of the industry. Everybody views multi-sig as a security enhancement, but the longer you stay in Bitcoin, the more likely you are to self-custody. And those people that are most security conscious view sovereignty not just as a philosophical value, but also as a security feature. They generally hold their Bitcoin on single keys or single key devices, whether it's a ledger or Trezor or a cold stored air-gapped computer. And so the problem that we set out to solve was, how do you deliver multi-sig to that core group of people so that we can help them better secure their Bitcoin, but then over time we can our core strategy is to then sell through additional financial services. So solve a problem for people at a low cost, and then over time sell the loan products. That currently means dollar loans. Eventually we'll crack the code in terms of the way that we're comfortable of lending Bitcoin out, and then in the future it's helping to fulfill payments and converting from dollars to Bitcoin, or just anything that a bank does we'll likely do. So we were up here in New York to show it off, to the actual demo off to people up here in New York. We've obviously got a lot of friends in New York that care about Bitcoin and care about private key management, and that's really what we're doing. We're, I think, on the right side of the fence of helping people understand that key management is important. The way that we think about it is pushing security to the edge of the network, and that if we put keys in people's hands and in a way that creates redundancy and allows them to have a financial partner alongside them, that is the best way to achieve the best security outcome. So.
Yeah, no, the security first mindset is something that I appreciate immensely, especially in Bitcoin. And that's what drove touched on last night, and which we touch on a lot in this podcast, is that Bitcoin is a bearer asset, and the ways in which you approach the custody and security of this is vastly different than what your typical consumer and investor is used to with the incumbent financial system. So one thing, your product in particular, I've been thinking of ways which I'm going to use it. I think this is a very good time to like jump into an example of a potential use case, is like TFTC, Tales from the Crypt. We're like building stuff and eventually want to make this into a revenue producing business. And the way I see potential scenario of interacting with Unchained's vault is setting up a vault and a multi-sig with a business partner, and basically keeping our cold storage there, funds there that we make in Bitcoin via the service. And then eventually, if we get enough in that account, just use your loan service pretty easily. And this is the access to capital with this product. Again, security first is incredibly, immensely comforting as a business owner. And then the access to capital on top, just added on top of that, seems like a no-brainer for somebody thinking of like a closed-loop Bitcoin economy. Yeah,
and that's really how we think about it. We think about it as first help people secure their assets, and then if we have those additional financial products layered on top or fully integrated with it, that you can then access them very easily. And so what we also, when we set off on this course to carve out the security piece that was backing the collateral security for loans, was that not everyone today needs loans. But when they take a loan from Unchained, they were really taking two services bundled as one. They were taking the loan itself and accessing the liquidity, but the most important thing that a person in Bitcoin, if they're in the market for a potential loan, is how is that Bitcoin secured? How, is it transparent? Is it being held in a dedicated address? And so the idea being that because that is such a hard decision point, and it's less about do I need a loan and more about do I trust how this actual Bitcoin is being stored, that we can reach a much broader customer set by just fulfilling the security piece in a way that allows them to control private keys, and that if they ever need the actual Bitcoin to access liquidity and they don't want to have a tax inefficient way of doing that through a buy and sell, then they actually can just with a couple clicks of a button access a loan through our platform as well. And so today, again, that's dollar loans, but in the future we'll integrate additional financial services next to the vaults.
Yeah, I think we need to take a moment to quell the fears of the hardcore Bitcoiners out there who are hyper security conscious. And why are you interacting with a third party Bitcoin? Bitcoin's like on your own keys, on your own Bitcoin. And I think we're at a stage where we have to get hardcore Bitcoiners. We're not even like trying to go after no coiners or people who haven't adopted Bitcoin yet. It's like hardcore long time hodlers to convince them like, hey, there are ways to utilize these services and keep your privacy and other parts of your stash and stuff like that. And so that's one thing that I've been watching unfold the last few months in particular that was the last in particular, hopefully, is sort of the backlash against these financial products on top of Bitcoin. And it's trying to sort of make people aware that, hey, these products are going to be a thing and you don't have to interact with all of them. And when you do, there's smart ways to do it, which I think you guys are building a great smart way to interact with these type of products.
Yeah, I think if at the core Bitcoin is money, which is how I think of it, and I think of how the majority of the people that we interact with and the people that are our core customers or the people that we believe are our target customers think about Bitcoin, that the way to add value on top of just the security piece is additional financial services. If Bitcoin is money, then people over time will increasingly need financial services, whether that's a business in a safe way to receive payments, or paying people, or if you're a retail company and you need to be accepting multiple payments throughout the day, whether it's accessing something like Lightning, or just having a secure vault that you can publicize your public address and actually secure those funds in a way that you're comfortable with, or if you have a multi-person organization, so that you can interact with those funds in a way that creates hierarchies at an account level. So that is how we think about it. And then beyond the vault, as you take additional financial services, you only see that sovereignty to the extent that you take financial services, and then depending on what type of service and the percentage that if you need to access a loan, only to the extent that you need that loan. So it wouldn't be putting 100% of your assets up. It would just be the extent to which you need the liquidity. So that's how we view it, and we understand also, and the other things that we try to solve for are privacy. But principally what we're trying to solve for at the same time, and it's all about striking a balance, is achieving that higher level of security. First and foremost, and privacy is a piece of that security apparatus. But there's also a reality that if you believe that multi-sig is a more secure way or a more redundant way to secure your Bitcoin, if you ever put any other entity into that quorum as a single key, it's very difficult to achieve 100% anonymity. So for people who are looking for 100% anonymity, there just may not be anything that we can solve for 100%. There's a lot of things that we do, and we'll be more public about the things that we do to make sure that names aren't de-anonymized or linked to actual addresses. But it's also why we open source our application, and we're working on an interface to go with that open source application, where for those people that do value that higher security but don't want additional financial services and do value 100% anonymity, that those open source tools are really what they should use to secure their Bitcoin. But over time, we think that Bitcoin owners are going to need additional financial services, and we'll be there hopefully to be a partner.
How the hell did you get here? That's what I want to focus on most of this discussion, is how you got here, how you got into Bitcoin, how you ended up at Unchained, what principally sort of drove you to Bitcoin. Yeah,
so if I just go through my 30-second Oscars thank you tour of the people that I probably most am appreciative of helping me to just understand Bitcoin. I think I probably learned about it for the first time from Will Cole and my friend Brooks Dudley. Both of those guys, definitely underrated. Stand-up gentlemen, underrated Bitcoiners. Guys who were talking to me about it back in probably 2013 and 2014. I like to consider myself a reformed no-coiner, but they helped me understand kind of and get interested in the first place, and then through their relationships with them helped me get connected with Safe. Particularly Will Cole and his brother Napoleon got me connected with Safe. I was actually working for a hedge fund at the time, and was going up to Canada to diligence a gold company, and it was called BitGold.
Mm-hmm.
And
is that Roy Saberg's thing?
Yeah, Roy Sabag. So I also learned a lot from Roy. Don't agree with Roy on everything, but when it comes to understanding debt and thinking about the Fed and gold, and it was a combination of talking with him and Safe that really helped me understand the monetary aspects of gold. Probably 4 years ago when I met them, I was somebody who thought that gold wasn't money or that it was a barbaric relic, and that it was actually going through both the understanding of why gold was money, how it emerged as money, how it was similar to Bitcoin at the same time that I was going down and doing macro research on the Fed. That combination of those three things really led me to Bitcoin. And I don't know which singular thing, but I think it was the combination. It was understanding first and foremost what money was, which was fairly remarkable that you can go get an economics degree
and not learn that.
Right? Yeah.
I did that. That happened to me.
You go to Safe University for
2 days.
Maybe 3 months, 6 months, you'll get there.
Right? No, but it's crazy. And so you are what I would consider a Fed supermensch. You understand the interweavings of the Fed and their policies, particularly over the last decade. You've done a lot of research and have written one of my favorite economic papers that's been released in the last... It's not on economic theory or anything. It's just a prescriptive description of... a description of the Fed's goalpost moving, and just... not even their goalpost moving. You documented the Fed's comments between 2005 and 2012 up to that point?
Yeah. Yeah, so it's not my own theory, so it's not this made-up thing called MMT, which I had never heard of. I worked for an investment bank for 3 years, worked in restructuring, worked for a hedge fund for 6 years, and never heard of MMT until the last 6 months.
6 months? Really?
Yeah.
It's popped up out of nowhere.
So, but so when I was working for a hedge fund at the time, and I was... I'd been learning about Bitcoin and starting to go down the rabbit hole, but hadn't totally been red-pilled. And while I was there, the hedge fund I was at had basically shifted from doing a lot of things to doing principal macro trading. So they always did macro, but if I came in and was working on long short equity and special event credit, by the time that I'd been there for 4 years, it was 80% global macro, and that was really what the sweet spot of the firm was. So in order to contribute, I needed to find a way to plug in. And at that time, the Fed had started to talk about unwinding its balance sheet. And there were so many things that just didn't make sense. And I was looking for answers of what happens when the Fed reverses what it did in 2008, 9, 11, 12, 13, 14. And so that path, in order to understand what I think happens when it unwinds, was what did they actually do? How did QE actually work? What was their actual thought process, in that moment in 2008 and 2009 leading up to it? Because you can't know what I think happens next without understanding the actual transmission mechanism of what their goals were and what their psychology is. And so I set out on a path, and there was a guy who I was reading articles that were macro-related articles. I believe the guy's name was Jeffrey Snyder, and he was the one who actually, didn't suggest to me personally, but was suggesting that I go back and read the transcripts. So 5 years after the fact, the Fed releases minutes 2 weeks after the fact after meetings, but then they release the full transcripts of those meetings 5 years later. So when I was going through this process of doing this research, and I guess it would have been 2017, the last year that was available was 2011. So that's 6 years, but like basically the 5th year is released in the 6th year. And one of the interesting things about that period, and again, I was in financial services at the time, but didn't have an appreciation for it. 2011 started to look a lot like 2008, and it was after QE1. It was really after 8 cuts in interest rates from 4% or 4.5% to 0, after the liquidity crisis, after QE1, after QE2.
Well, before you even get into like 2011 and 2008, I think what's imperative about Ender's Game, the paper that you wrote on this stuff, is going all the way back to 2005 and saying what Bernanke said. I believe there was a hiccup in the housing market or the S&P in February.
I think it was 2007.
2007.
There were some quotes from 2005. There was, and really the way that I came to form a view on it was that, whether it was 2004 or 2005, there were a lot of people that were really attributing the low period of volatility that had been experienced from the mid-1980s or early 1980s until 2005 or 2006, that was basically the Fed patting themselves on the back. Like the active monetary policy has contributed to both low price volatility as well as low output volatility. And that when you go back and look at some of the things that Bernanke was saying relative to the impact of monetary policy leading up to the financial crisis, and then once I do remember this from the time I was working at Deutsche Bank at the time, down in the financial district. The cracks in the facade started to appear in 2007, even more so in early 2008. But there are these quotes, if you go back and look at it, that the Fed was, I don't want to say blindsided, but they did not have a good read on what was going on. They were making comments.
I think blindsided's a good descriptor.
Yeah, I think that would be fair. Safe cautions me to not treat those people as idiots, because they're certainly not idiots. But when it comes to their ability to forecast, it's extremely limited. And so when you go back and look in the historical context of just the things that they were saying leading up to the financial crisis, and then you come away with the perspective that these were also the people that were deciding how to allocate trillions of dollars, and then also how they actually think about those decisions, because they do take it seriously, but 750 billion to $1 trillion is a rounding error for them. And so I think some of the comments leading up to the actual crisis were along the lines of, the Fed does not expect a recession. Bernanke made some comment about how the GSEs were adequately capitalized, and that I think he made a comment around the lines of the financial markets were deep and liquid. And so you take the aggregate of those, and that's similar to what I was doing when I was going back and reading the transcripts. You know the ending to the story, and you see how the people in charge, what they actually thought, and then how they made decisions and how their actions were actually consistent with their prior views, and kind of starting to question the whole idea of why do you have 12 people sitting around a table deciding how
Deciding this.
trillions of dollars are allocated?
And so I have the tweet thread that I wrote on your paper up. And in 2004, Bernanke and crew expressed their beliefs that monetary policies they had been pursuing reduced volatility of inflation and output. In reality, they were just suppressing the volatility that was unleashed in 2008. But you really set the tone with the paper. Like in particular, the 2 decades leading up to 2008 saw debt in the U.S. nearly quintuple from 11.2 trillion to 52.5 trillion. With mortgage and financial debt leading the charge. So you sort of have this 2 decades of debt buildup, the Fed enabling this debt buildup and thinking it's basically reducing volatility, and then being unleashed in 2008 with, obviously, the Great Recession. And I guess we should dive into the mechanisms of the Fed, how they sort of manipulate these markets and how they sort of skew the price mechanism of the world and sort of hide this volatility for a good amount of time, but it eventually rears its head. The hens come to roost.
Yeah, so, and part of my thinking about this has been shaped around not only reading the Fed transcripts, but also reading a lot of Hayek, Frederick Hayek, again, which somehow I went through economics and never read. But as I suggest that everybody...
I got a degree in economics.
You know,
I never once learned about Hayek.
Yeah, maybe before people even get to the Bitcoin standard, if they would just read The Road to Serfdom. The Road to Serfdom, and then a couple essays that he also wrote, The Pretense of Knowledge and the Use of Knowledge in Society. And it helps kind of understand why price manipulation distorts the actual underlying economic activity. And when you start thinking about that relative to what the Fed is doing, that it's more pervasive than even setting price controls. It's by manipulating the money supply, you're manipulating every price in the market because the dollar is the unit of count. So the only way, and that's another kind of one of the takeaways from the work that I did, was there's a lot of fancy words that the Fed talks about in terms of their operations. There's IOER, interest on overnight excess reserves. There's, they refer to quantitative easing as large-scale asset purchases.
Operation Twist.
A lot of things that they do to quote, maintain low volatility or price stability. But realistically, all it is inflating the money supply or manipulating the money supply, and interest rate targeting. And really, the only way to target an interest rate is to manipulate the supply of it. And they do that not just by buying and selling, but also buying and selling at different term structures. And so when I was going back through and looking at what the Fed had done from the course of 2009 to today, one of the things that I really tried to do for myself to understand it was just see what the playing field was, just like form for myself how to really view the right way to think about of what the Fed did. And the way that I started to think about it was, what was the size of the credit system from 2000, what was it in 2007 versus what is it in 2009? And that's when you start to think about, and these are just Fed numbers, but in 2007, the U.S. credit system, so just fixed liability, fixed maturity debt. Like, don't think about derivatives and CDOs and CDS, just fixed liability debt with fixed maturity schedules. It was $53 trillion at the time. And at that time, the banks in total had $350 billion of cash. So each dollar had essentially been lent out.
Up.
Yeah, 150 to 1.
Yeah.
Each dollar had been pledged 150 to 1. And there was no way that every dollar could be paid back. And so I kind of, when I was going through my research, it was this realization. I think it's not a unique realization, but that subprime was just the match that lit the fire, and what the fire was the banking system itself and how levered it was and how insolvent it was. And that what the Fed really did, through QE1 was they were addressing the liquidity issue. And through QE2 and QE3, they really weren't. And there was a famous Ben Bernanke 60 Minutes interview in December, I think it was December 10th.
Our hero, Ben.
December 5th, 2010, where he was talking about how what the Fed was doing was not printing money. And I started to view it from this perspective of everyone either thought he was lying or being highly disingenuous. But when you read the actual transcripts, the Fed thought what they were doing through QE2 was different than QE1, and they were interest rate targeting through QE2 and QE3. They weren't adding liquidity. They didn't necessarily think liquidity was the issue that they were solving for. And it's a really interesting nuance, but it's one where it signals to you that
how does injecting liquidity, like, how did they square that? Like, they don't think they're solving a liquidity problem by injecting liquidity. Like,
so they were injecting liquidity but they viewed themselves as converting one form of money, central bank reserves or dollars, bank reserves, for something that was near money, which would be treasuries. Now, when they started to go into the MBS world, that made people within the Fed uncomfortable, but they continued to do it. So, the Fed would view treasuries as near money, and probably MBS as, further away or less defensible, but something that was similar to money. Because if you think about it, when they were buying treasuries, so somebody has a treasury and they're making a dollar return on that, and suddenly if they only have the dollar, that's less attractive to them because they no longer have the yield. So it doesn't instantaneously, it's not like helicopter dropping money all over the place. It's essentially what they were doing was de-levering the system. They were increasing the denominator. If at the beginning of the financial crisis there was $53 trillion in debt in the U.S. system, and there were only $350 billion in the system, by, say, from start to finish, if they increased the amount of dollars by 3.6 trillion, just by that function alone, they de-levered the economy, and then that inflation would be seen over time. And so, but realistically, what they were doing was again, through QE1, they solved a liquidity problem. And the bank bailouts, which weren't expressly QE1 but were related to it, were about solving the liquidity problem, stopping the downward negative pro-cyclical credit contraction that was causing virtually any bank in the system, like, probably would have failed if it had just if the course had just run out, and that was not a scenario that would have been okay by the Fed. And so what they did through those emergency measures in QE1 was solving liquidity problems. What they did through QE2 was, we need to, again, because in a monetarist world, the only way, not the only way, but they're 90
effective way.
Well, in their view, the effective way to achieve full employment and to achieve their mandate is through this famous word or famous pair of words, that's aggregate demand. That we have to spur aggregate demand, and the only way to stoke aggregate demand is to ease monetary conditions, lower interest rates, so that people have an incentive to borrow. And that's what they did through QE2 and QE3. They just needed a bigger boat, and they needed to lower longer-term interest rates to incentivize the type of demand that they wanted. So that's why when I say that QE2 and QE3 they were interest rate targeting. And so what Bernanke, when he went on 60 Minutes in 2010 and said we're not printing money, they technically weren't. They were creating reserves. The Treasury is who prints money, but the Fed is who creates dollars. And so there's a few steps in between there, but again, their motivation through QE2 and QE3 were, how do we get interest rates low enough so that somebody then goes and builds a real estate project? And they focus a lot on credit spreads. And so when you see that, and you see the progress of, if QE1 was effective, why do they need QE2? If QE2 is effective, why do they need QE3? And so it's just, looking at the historical lens leads you to things, and understanding the playing field leads you to the conclusion. That's why I also got into Bitcoin, which was, if you understand that there's 70 trillion of debt and only $2 trillion of dollars today, again, the system is not fixed. It's just, one more round of QE away, and that's why Bitcoin exists. And I think that's why we're all, some people may come for the sound money and stay for the technology, but more people probably come for the tech and stay for the sound money.
No, I would agree. And so I guess that begs the question, is how much longer can the Fed do this? And one thing that I talk a lot about is just looking at the Fed funds rate and sort of moving lower towards the x-axis on this fractal, where it's at a point where it doesn't seem likely that it'll go over 3% anytime soon, and may actually, in a worst case scenario, have to go into negative interest rate policy. And just last week, Chairman Powell came out and said he doesn't expect the Fed to hike rates at all this year, where previous meeting he said they probably expected 2 hikes at least this year. So it seems like they're backpedaling a little bit. And where do you think they are right now in April 2019?
Yeah, I think the first thing to recognize is that they shifted course real quickly.
Right.
And in a lot of people, there's this idea in the hedge fund world of good news is bad news, or bad news is good news, really, where the Fed, so long as the Fed is accommodative, you want to be in risk assets. And I have a lot of people that I've been talking to about what my views of the Fed are. One of the things that I've been, my view is that QE is coming, and it's coming a lot sooner than people expect. Some people may view that as, go buy equities and have exposure to the stock market. And for those people, I just remind them that, again, if you go back to 2008, the chinks in the armor were there. The Fed shifted course, and they reduced interest rates 7 times from 4.5% to 0, and then there was the liquidity crisis, and then they did QE. And so there's a lot of risk between here or there. So I think that what the Fed signaled in March was that they're going to start tapering the unwind. So if they're reducing $50 billion,
tapering the unwind. What an Orwellian use of language there.
Yeah, they are tapering the unwind.
Tapering the taper.
Only about 18 months after they started the unwind. So they had easy money for 9 years, and they told us the problems were solved. But then the second they get Fed funds to 2.5%, and they literally invert the yield curve, which is a terrible sign.
Not a good sign.
Not a good sign. Let's just be honest.
You don't want the
that.
yield curve to look like a Nike swoosh.
Fed funds is higher than the 5-year. I think I think the 1 year is equal to the 10-year. It's yeah. So if somebody tells you that that's a bullish sign, they're looking at the wrong market. But I think the most important thing is, and again, this partly goes back to the part of the way that I read the Fed, and I really suggest that people, as an exercise, do it. Not everybody has time to read 290 pages. Each meeting's about 290 pages, but
thank you for your service. Thank you. I don't know how you did it.
You get good at it.
And we found out yesterday or 2 days ago that you had to put up with some pretty hubristic talk as well.
Yeah,
because you were looking at more recent minutes, correct?
I was looking at the 2012 minutes, just getting prepared for this. I needed to have a few nuggets for you for that. But one of the things that you glean in all the Fed transcripts, they're set up the same way. So they do an economic roundtable. There's some summaries, and then they do a monetary policy roundtable. And so you can really focus your time and energy around key decisions. Like we know when QE 3 and 4 was announced, and so you can go to that meeting and read and actually understand the psychology. But one of the interesting things was that in 2011, the Fed, virtually to a person, thought that they were going to be unwinding. So this was June of 2011. They thought they were going to be unwinding QE2 in early 2012. I don't think so. If you actually go back and look at what QE2 will never be unwound. So just to be clear, they started unwinding the balance sheet in October 2017, but they will never get to the level that it was at just after QE2, based on what the Fed has currently said. But so that shows you that they were wrong. But then also at that time, they went through a roundtable and they asked, well, okay, how will we start to reverse what we've done today or through QE1 and QE2 when it's time to do that? What will be the sequence? And again, almost to a person, I think 15 out of 16 said that they would first start to reduce the balance sheet and then they would start to raise short-term interest rates. Again, we don't know what changed in their thinking necessarily, but in 2015 they decided they were going to start to raise short-term interest rates, and they didn't start to unwind the balance sheet until 2017. So part of it's what you learn by actually reading it, but part of it's just by you're reading a book but knowing the ending.
Right. And
you start to appreciate that these people are continually wrong.
Not only continually, serially wrong. Criminally serially wrong. For being in the position that they are, they're supposed to be experts, and that's what. Yeah, and then they go forward. So if you fast forward to the next year in 2012, in 2011, there were people who were, within the Fed, throwing their hands up about monetizing the debt and how they shouldn't monetize the debt, and very clearly what Powell's just come out and announced that starting in May they're going to start to taper the unwind, and then in September they're going to be done. They monetize the debt. That should be the question that's asked of Chairman Powell. Did you monetize the debt? Yellen came out and suggested we go full BOJ, investing in equities and stuff.
Yeah, there's an investor that I like to pay attention to who's also invested in the crypto space, Mark Yusko. He often uses the tagline "Becoming Japan," and so I think he's a great advocate for the space. But he also I think he sees a lot of the same problems that I see and think about the monetary system the same way, or the legacy monetary system, and it is one of the reasons that brought us to Bitcoin. But going back to your point about the 2012 pieces was you had these people who, there were some certain dissenting voices within the Fed about how the Fed shouldn't be in the business of credit allocation, specifically speaking to, why is the Fed buying mortgage-backed securities? And it's really phenomenal to know that through QE1 and QE2, and QE1 and QE3, the Fed bought, I think, 17% of all mortgages through MBS, and that there was such a backlash, at least within certain members of the Fed, that they thought that they should never do that. And then in 2012, they went ahead and authorized buying $40 billion a month for virtually 2 years. And there was an exchange within that Fed meeting, and I posted on Twitter the other day, where and the guy who actually asked the question was like, "What do you want the USA Today headline to be?" He was actually the guy that was most opposed to the Fed buying MBS, and he was the only person from that meeting that actually dissented. You would think that if you had that much of a disagreement, the dissent should be resignation. But he basically asked, "What do you think? What do you want the USA Today headline to be?" And Bernanke's response, and again, he was joking, but still, when these people are talking
no self-awareness,
like no self-awareness that people are going to be reading this 5 years later. It was Bernanke the hero was the first headline that he suggested, and then the second one was...
Well, that was actually a headline on the Atlantic.
I didn't even know that. I just
thought
it was
Atlantic,
ridiculous.
I believe. It wasn't USA Today, but on the Atlantic, I believe they posted a cover page of Bernanke, hero, in green money colored letters. But
yeah. But so it was Bernanke the hero, and then, Bernanke supports the labor market. And then somebody asked, by buying MBS? ? And then I think Bernanke responded, housing. People understand housing.
Oh, my gosh.
And then the guy who asked the question initially was like, okay. And that was the exchange, where...
Hopefully he was shaking his head.
These people, and this was something that Safe helped me understand, of just, why central bank manipulation doesn't make sense at a first principles level, is that 12 people can't sit around a table and reasonably decide how $1 trillion gets allocated.
Can't micromanage.
But the people who are doing that, they're doing it both with the background of being serially wrong and deploying the same tools when doing the same thing hadn't worked before, and doing it while also recognizing, again, it's not as if there isn't dissent within the Fed. The dissent within the Fed is generally much greater than the minutes suggest. But rather than go to the mat, because again, the Fed wouldn't work if there were actually Austrians involved. Could you imagine that if 1 out of 12 every time was just no?
And then it's all confidence game. You can't have that dissent proliferate too much, or you lose confidence in the system at some point. But I wanted to stick on the MBS buying. So that's what led to Operation Twist, right? So Operation Twist was the program in which they unloaded their toxic assets, which included a lot of MBSs, correct? Or am I wrong?
No, so Operation Twist wasn't
that twisting out of toxic assets into cleaner ones?
No, it was the principal thing that Operation Twist is referring to is they changed the duration profile of the assets that they did hold, which basically signaled
went from shorter to longer term.
Yeah, that signaled that the level of support for the easy monetary conditions would be longer than initially expected.
Okay.
And that basically
misunderstanding on me there.
Yeah, that basically happened. So, and the other interesting thing was during 2011, and this is why I caution people today, that because of the makeup or because of the construction of the financial system, where the only way that a system can get so levered is that every time the system tries to self-correct or tries to restructure as a whole, overall deleveraging, the only way that it can continue to exist and that can metastasize is if the Fed manipulates the price of credit. And it does so through quantitative easing or large-scale asset purchases. And so, but the thing that I remind people of is in 2011, there was this progression over 6 months, which was everybody thought that the economy was getting better and that the risks were skewed to the upside, that there weren't a lot of downside risks in, say, January of 11. Then they remained confident in March, but then it got, increasingly, there were some signals on the wall that made them, not as confident. Then in April, May, people started to, see that economic fundamentals were, I don't want to say deteriorating, but were were not hitting expectations. 2011, they ended QE2, and then in August, there was basically they started to see signs of 2008.
I remember
and that's
this,
another an interesting thing that you see from the actual transcripts is, and I don't think many people have the appreciation for, is just how confused the Fed was that after they increased the excess reserves from $10 billion to $1.7 trillion, why there would be why there could ever be a liquidity crisis. Like, how could there be a liquidity crisis? And I think the answer to that is that they view liquidity through short-term needs, and that's not really how anybody finances their businesses or their lives. And because of the nature of of how levered the system is, that liquidity can disappear very quickly.
And isn't that's a scary thought too, because this is something I brought up at Baruch College last week. I went in to talk about Bitcoin to a college class with Matt Odell. And we got into monetary policy, and I brought up the Fed monetary base, and it's incredible if you look at that chart. Like, so from 1913 to 2008, the Fed's balance sheet expands from $0 to $800 billion, and then from 2008 to 2014 goes from $800 billion to $4.2 trillion or $4.4 trillion, whatever it is. It's a rounding error at that point. It's crazy that much liquidity was pumped into the system, yet they were still having liquidity issues in 2011 and
and it's really because of, and again, this is what I urge people, the way that I think about it, and the way that I urge people to kind of take a step back and look at the field as a whole. It's the size of the credit system relative to the actual number of dollars that exists, not the amount of deposits, but the bank reserves. If you look at the left side of the bank's balance sheets, in aggregate, they've got $2 trillion of reserves. Those $2 trillion of reserves are stacked up against $70 billion plus today of both bank debt liabilities and shadow bank liabilities. And so liquidity is only ever present so long as the system as a whole doesn't need it. When the system as a whole actually needs it, it evaporates very quickly. And that's what happened in 2008, and that's what happened started to happen in 2011.
So extrapolate on that, because that's another part of Ender's Game that you really drove home. Was you think there's liquidity, but when it comes time to need it, you realize that it's not really there. And how do they envision this liquidity flows, and how does it actually flow when it's actually needed?
Well, think about a mortgage REIT. Certain mortgage REITs borrow for 60 days and then go buy additional mortgages to take leverage. I don't know why anybody finances they're basically buying long-term assets, and they have short-term liabilities, and that's essentially what got us into 2008. And so again, so long as people in a real way don't need liquidity, then people can borrow at reasonable rates for 60 days or 30 days or 90 days. But once those cracks start to emerge and everybody starts all at once to realize that the game of musical chairs is far more than one chair short, then there start to be defaults, and everybody at the same time stops trusting those partners that are financing their businesses on a short-term basis, because generally any business that is doing that is for some sort of financial engineering, and that when that unwinds, it has a significant negative feedback loop. And so there's a waterfall or cascading effect that sets off one default actually causing the next default. And so I think the way that they think about it is, and certain people in the Fed, Richard Fisher talked about this in both 2011 and 2012, where he talks about how, and it's also why QE is so phenomenal and preposterous, is that there's people within the Fed that specifically raise questions like, I don't think we understand how overall system deleveraging impacts our models, but we're still willing to go,
our models
create $1.7 trillion without first understanding those questions. There's also other, one of the lead Fed economists, not one of the governors, he raised where, he basically was raising these questions about how, and I think he said something along the lines of, our ability to understand the impact of monetary policy on the real economy is severely limited, as it is with the entire profession. And when he refers to the profession, it's central bankers as a whole, or macro monetarists as a whole. And that it was great that people were doing the work to try to understand it, but that their work at that time, this would be 2011, 2012. He didn't know. It may not have been in its infancy, but it wasn't far beyond toddlerhood. So basically, these people within the Fed recognizing that they didn't actually understand what the effects or unintended consequences of QE would be, but they still, had the ill temperament to go out and spend $1 trillion,
Right.
or $3.6 trillion.
And that goes into like the philosophy behind the study of economics. Like, can you even make economic models? Are they viable? And is economics more of a look back and describe what happened, or try to predict what you can do via policy and stuff like that to the future? And
Yeah, I mean, in my perspective, the answer is no. Like, you can create models to be predictive, but you can't manage an economy from the top down.
And because that's how capitalism works. Right? Like new information, surprises is what makes capitalism go. Is new innovations, new information that has never been revealed to the market before, in the form of maybe a technological innovation or a discovery of a new precious metal, whatever it may be. That hasn't happened recently. It's just a hypothetical. You cannot make models around that, right? And thinking about how this innovation affects a whole global economy.
Yeah, I think, and so what I would strongly recommend people do is go read F.A. Hayek. Again, the combination, if you don't have a lot of time, and you probably have to read it multiple times, but reading The Pretense of Knowledge, which was his, I think, 1974 Nobel Prize winning, like he basically won the Nobel Prize that year, and that was his speech. And also The Use of Knowledge in Society. It's this idea, and I won't pretend to be able to express it as eloquently, in recognizing that his writings are actually also very dense, but it's the idea that no one possesses perfect knowledge, and that the idea of capitalism is disposing of the need to rely on any single or any central point of knowledge, and that through a lack of central planning, we can actually achieve through the price mechanism what we couldn't imagine achieving with central planning. And so I think it's The Use of Knowledge in Society, and the Use of Knowledge in Society and The Pretense of Knowledge are both probably 10 to 15 page essays, so digestible but also dense. But the idea that he uses to explain it, and Milton Friedman, who's also a monetarist who I dislike, but he also talks about the idea, like there's a YouTube video of all the inputs that go to creating a pencil, and Hayek talks about a similar or an explanation about how the price mechanism actually transmits knowledge throughout the world. And I don't know if this is the express example that he uses, but the way to think about it is there could be people in Texas or New York who are building homes, and they rely on copper to put in those homes or to wire homes, and there could be an earthquake in Chile, and the supply chains of copper, because Chile is a big exporter of copper, could suddenly be disrupted. And the guy who's building homes in Texas or New York or North Carolina doesn't have to know that there is a earthquake in Chile that just disrupted his supply chain that made the cost of copper go up. He just knows that the price of copper goes up, and so now he has to allocate resources differently. He either needs to charge his customers more, figure out some way to substitute that product, build homes that have less copper in it. But really the transmission mechanism of knowledge is the price mechanism, and that it can allow information to be disseminated over events that hundreds of millions of people in the world may not ever know about, technically, of what caused the change. They just need to know that the change occurred, and that actually is the price mechanism that actually transmits the knowledge. And that also what helped me think about the Fed and the realization that the only way, whether it's 1980, 2008, QE1, QE2, QE3, the only tool they really have is increasing the money supply, which manipulates
the pricing mechanism.
The pricing mechanism. And when you manipulate the pricing mechanism, you distort the underlying economic activity. And what that allows to happen is for all of that volatility that would otherwise have been resolved through smaller ups and downs to build up underneath the surface. And that's a lot of what Nassim Taleb talks about, that if you don't have fluctuations or volatility, then you're ultimately just kicking that can down the road, and you're going to get a probably more destructive or more impairing acute problem in the future.
Yeah, no, this is what another prolific Austrian economist touches on as well, Jörg Guido Holzmann, in The Ethics of Money Production, page 70 and 71, I believe.
I'll have to go back and read that.
It's incredible. He describes the mispricing of credit in particular, and the malinvestment that sort of ensues when you have easy monetary policy and easy access to credit via the Fed's liquidity goals and stuff like that. And so you have a misallocation of resources, and this ties back to Bitcoin, and sort of try to bring a sound money system into the conversation here. Like, the sound money system built on Bitcoin could potentially reduce the misallocation of funds in particular.
Yeah, I think the way that I think about that is if not everybody is an economics major, but if you just think about a simple supply and demand curve, that when the Fed pursues QE1, QE2, or QE3, they basically shift out the supply curve for dollars. And what that does is it creates an imbalance, an extended imbalance between people's willingness to borrow and people's willingness to lend. If the rate is lower and I have dollars to lend, I have a lower incentive to lend. But at the same time that I have a lower incentive to lend, the person that's borrowing is now being able to access capital on a cheaper basis, and they have an incremental incentive to borrow. And so the Fed, their actual goal through QE2 and QE3 was, I need to lower long-term interest rates so that I can incentivize borrowers to demand loans, and that is my way out of this. Like, think about how crazy that is. That is,
right?
We had a credit system that was incredibly unstable, and the way out of it is to induce more credit.
Time preference, paycheck to paycheck spending.
Yeah, totally crazy. And what you see, like, if you actually look and see where that credit was created, so pre-crisis 53 trillion, today 70 trillion, give or take a trillion. If we're throwing trillions around like the Fed does.
Which you shouldn't.
Which you shouldn't ever do. Trillions shouldn't be a word in policymakers or in the Fed's terminology, but once we get to a 21 million unit of account in total,
it'll be impossible.
We'll take out the whole $1 trillion problem. But
it's a big problem. It's a big problem.
But well, I totally lost my train of thought there.
We're talking about trillions, pricing mechanism, Guido Holzman, misallocation, sound money standard on Bitcoin will help. So you're saying the Fed's policy is sort of the way out of this credit crisis
was to induce
people
more credit. So
yes.
Yeah, 53 trillion pre-crisis, 70 trillion today, and that if you thought about any individual industry or company, restructuring is a positive thing. I worked in restructuring for a long time. If you were a telecom company, a legacy telecom company, and you had too much debt, that debt needs to be restructured. New economies or new industries emerge. And if you think about it on a micro level, like, it makes sense that certain companies go out of business and they need to be restructured, and bad debts need to be written off. Same thing with zombie economies and zombie industries. But the Fed's monetary policy essentially allows those industries to continue on longer than they otherwise would. And so when people look at individual companies or individual industries and believe that restructuring or writing off of bad debts is a good thing, it all makes sense. But then when you apply that to the market as a whole, it suddenly doesn't. And I think that's really what has happened. It's been this unfettered credit expansion, fostered by a shift in Fed doctrine, but as well as a departure from sound money that's allowed. And it's really interesting if you look at the size of the credit system relative to GDP in the United States going back to the 1940s. It was virtually constant at about 150% from the 1940s to the mid 1980s. Obviously, in the early 1970s, we actually departed from the true gold standard. The gold convertibility officially ended in 1971, but then the Fed doctrine of how they would deal with the booms and busts and trying to even out those business cycles was to manipulate the supply of money. That increasingly became a tool, and when you see what's happened since the late 1970s and early 1980s was that relative proportion from basically debt to GDP went from 150%, which was constant for 40 years, to magically over the next 30 years to 350% or 400%. And so what that essentially means is the credit system the growth in the credit system far outpaced the growth in the underlying economy, and that simply wouldn't have been possible if every time the credit system as a whole tried to restructure, that the Fed didn't step in and not allow it. And their approach has been, you take an unstable or unsustainable credit system, and the best way to deal with it is to reflate assets so that amount of debt can be sustained, rather than allow the debt to be restructured to an amount that makes sense relative to the economic activity. And that's, I think, essentially what gets to where we're at today, or where we were at in 2008, where you had this undercurrent building up for a very long period of time because of that type of behavior.
And once you understand this, it's hard
It's hard to unsee it.
It's hard to unsee it, and then it's hard not to see SAFE's view of the world where monetary policy does make everything worse off. So, like, a lot of people want to talk about the environmental situation that we're in and stuff like that, and they want to throw money at the problem. But I would argue, like, the system has led us to this problem in ways where it allows misallocation of funds and incentivizes people to make shitty plastic things that are just sold frivolously, and shitty housing, and we don't have good architecture anymore because nobody has the time preference to think about building good, worthwhile things that'll last for decades or centuries even. Nobody's thinking about centuries time scale right now.
Yeah.
I
totally agree. So one, I think that SAFE's view, and this was something that before I think I even actually got into Bitcoin, or I mean, I was interested, but I hadn't been red-pilled yet. He made a comment to me that was that central bankers create financial crises. And I think that if you start to look at the world in this lens, it makes 100% of sense. That, and at a root level or at a first principle level, that baseline is the Fed manipulates the pricing mechanism rather than allowing the economy to restructure. It puts that off, and then the ultimate restructuring or the ultimate come to Jesus moment is actually way worse because they suppress volatility over the long term. And so that's the thing that I tell people. I give everybody that I can possibly meet a copy of his book. But I also recognize that if you are especially trained in economics and by a Western university, that you probably read Safe's book and think it's
asinine.
It's asinine. Like, you have a visceral reaction.
Right.
You literally, if you read his book based on your prior education, you think it's crazy and it's not reasonable and he's probably lying about something. But if you just apply your actual real world experience and, kind of having lived through the financial crisis, again, being at Deutsche Bank from 2006 to 2009, going and working in restructuring, working for a hedge fund, if you just evaluate the type of concepts that he talks about relative to your real world experiences, I think you come out on the same side. And that's why I think Bitcoin is going to be so successful, because we're going to win the war of ideas.
Right?
That we just are. It's very simple that if you actually go and talk to somebody and ask them, hey, you did some work for me today, do you want to be paid in the form of currency that is fixed in supply? Don't have to explain to you why it's fixed in supply, but just that start there as a baseline. Or do you want to be paid in the form of currency that your government can and does and regularly tells you that they manipulate and that they target? That the average person will accept version A.
Right.
It's just a logical choice.
Well, it's a
and it's far more complicated than that.
It's a logical choice, and it's an optionality that hasn't existed for most people up to this point.
Yeah, you did not have an opt-out in 2009.
Yes, and this is another big theme recently on this podcast last 3 months, is especially after Messire came on and described you're giving up your very scarce time for a very inflatable resource. You should think about giving up your scarce time for a scarce money as well. And especially, and this is a topic that we talked about last episode with Johnny Dilly, Tom Garambone, and Matt Odell, is you have the average American, 60% of Americans can't afford a $400 emergency expense because they don't have a savings vehicle, essentially, at the end of the day. You cannot save purchasing power, like not just money, purchasing power throughout time in our current economy. Your plumber, your teacher, your crossing guard, if they're lucky enough to have enough money to save, they're usually forced to chase yield in whether it be a mutual fund or some other investment vehicle. And then they often get the short end of the stick when hens come home to roost and the system corrects. Yeah,
so our friend Napoleon, who I think he's a lurker on Twitter. He's a very early, a good Bitcoiner. He's Will's brother. He's got this tweet from 2014 that says, only invest in the USD what you can afford to lose.
Right?
Right? And so when people think about, and it's kind of, Mark Yusko also talks about the boiling frog. And when you think about inflation on a single year or, a 1 or 2 year period, a very, high time preference, short period, and you realize that the Fed's targeting 2%, that they're telling you they're intending to cause your money to lose 2% of its value, people kind of get, in the mainstream, get lulled to sleep by that. Of, 2% a year, my wages are going up.
Not that much.
Not that much, no big deal. But think about that over 10 years or over 20 years, a decade or 2 decades, where you're having to replicate 20% or 40% of your wealth just to stay in place, essentially, right? Like it's akin to running on a treadmill as fast as you can to replace 20% over a decade or 40% of your wealth over 2 decades. If the Fed's 2%, which nobody believes, Safe talks a lot about how the actual inflation rate is far higher because
the CPI is the most manipulated metric that the Fed has out there.
Yeah, and I'm not going to go through his analogy of ribeyes, but it's a good one.
No, it's a good one, and that's Rudy Van Havenstein. Shout out Rudy Van Havenstein on Twitter, one of my favorite FinTwit followers. He's a parody account of the chairman of the Reichsbank when it went bust in the early 1900s. But I brought up a couple years ago, they're going to tell you, because when I was in the futures market, we traded lean hogs and cattle and stuff like that. And if you pull up a chart of lean hogs and cattle, which make up some of the best meat that this country has to offer, they're almost straight up and to the right. And so that there's obviously been price inflation in those markets, but the CPI would tell you otherwise. And he came in and is like, yeah, well, they replaced those meats with rough rice. Like, rough rice has not changed price much over the last couple of years, but they're going to tell you that it's reflective of the overall sort of pricing condition of the market.
Right, because and I'm not going to go into the details because Safe or Rudy can explain it far better than I can, but the idea being that because of the way that the Fed tracks it, people as those things become more expensive, they leave the basket and then they substitute for cheaper things. So they're actually
substitute your good lean cattle for rough rice.
It's not just food; it's just real goods and services, and you deteriorate your quality wherever it may be in the quality that a home that is built. It's not subject to just food,
right? No, and then you look at the most essential needs in this country, which would be healthcare, education. I wouldn't argue that education as current form is as essential, but it's viewed as essential in this country. And real estate are some of the most highly inflating markets over the last decade, and they're going to piss on your face and tell you it's raining and tell you the inflation's subdued at 2%. It doesn't make any fucking sense.
Yeah, I've been trying to find. There's a chart, and if you look at inflation of goods or assets that are either heavily regulated or are actively
subsidized
or actively manipulated by the Fed, it's basically any free market. The price of goods go down.
Technology, TVs, clothes.
Yeah, which is really one of the principal underlying ideas of capitalism is how to create the same or more with fewer resources and be able to deliver that to a large market of people. But if you look at healthcare or education or housing, just think about the fact that this was part of
pillars of our society.
Right. Yeah, our core pillars of our society. Like the Fed either through their student loan. Like if you look at student loans, holy shit.
What did you think was going to happen? The government tells
you make debt free. Kids are going to go take the drugs,
and then the universities are going to be like, all right, you're offering the debt, we're going to raise prices. You're not going to stop offering these loans, so we're going to raise prices to see how much you'll pay.
Yeah, and so if you look at the housing market, and this is one of the things, and I'm happy to figure out a way to just make the white paper. Well, it's not a white paper. It's not like an ICO white paper. It's just a research piece.
It's a very good
research
piece.
40 pages. But if you read it, one of the things I talk about, and you start to understand some of the imbalances in the manipulation of price, the housing market. The housing market is far through where we were in, quote, the housing bubble in 2007,
right,
on a nationwide basis.
In this city is we're looking at some of the buildings that are causing this.
Yeah, we're sitting on a rooftop and seeing some brand new high-end construction in Brooklyn that probably can never be afforded in 10 years or afforded. But when you look at that and you see, okay, we're through the 2007 price levels, but labor participation is lower. There's actually fewer number of households that actually own homes. So there's actually more households, but the homeowner percentage is lower. And when you look at the actual components of where the labor participation rate has actually lagged, it's not just it's actually older people are contributing to the workforce in an increasing way, but people who are 16 to 54 on a gross basis, if you just looked at a snapshot, again, the census does it every 10 years, so 2004 to 2014, there were actually fewer number of people that were 16 to 54 working in the United States or participating in the labor force in that 10-year gap.
And at the same time, you have the labor force participation rate of people in the 55 to 65 age bracket going up, which is crazy.
Yeah. And so when all of those things are true, the price level of homes are actually higher than they were in 2007, which everybody agreed was a bubble. And then you start to realize that, the only way that that was possible was that the Fed went and bought $1.7 trillion of mortgages. Right, like they actually reduced the rate of a mortgage from whatever it was before that was probably manipulated, but the housing market could not exist in its form today if the Fed hadn't gone and bought 17% of all mortgages that exist. And now that we see, like, as they're trying to get out of the business of monetizing both the federal debt and the mortgages, they're finding that they can't do that.
Right.
Because if they do that, everything is pro-cyclical. If housing prices start to drop again, then people's perception of their wealth drops, and then they spend less. And again, aggregate demand is the way to get full employment. So it's really a catch-22, and the Fed is shown in the past. And this is one of the things you also get from reading the transcripts. And I don't suggest that everybody reads every transcript, but if you go and read the core meetings around, when QE3 was announced, when the European debt crisis happened in August of 2011. You realize that the Fed has this mentality, and Ben Bernanke admits it himself. He'll make comments like, and again, he's not the Fed chair anymore, but he was at the time, where he'll recognize that monetary policy may not be the problem, and there may be fiscal and structural problems that monetary policy can't solve. But in his terms, we have to be palliative. We have to do something.
Do something.
And
like the need to do, or the thought that you need to do something exists. Like, it's prevalent throughout all the Fed's doings.
Right, and in the Fed's world, that is, we literally have the power to decide that we're going to buy $40 billion worth of mortgages, or MBS, not direct mortgages, but mortgage-backed securities, every month for an indefinite period of time. And then 3 months later, in December of 2012, they would add $45 billion a month of treasuries as well. So they were buying $85 billion of base money a month, which is just crazy that 12 people that are unelected have that power. And that when you start to read Safe's book and understand monetary economics, you realize that no one can efficiently allocate capital that way.
This does not end well.
Does not end well.
So let's end on that. How does this end? Like, how do we transition out of this? Like, there's going to have to be some pain. How much pain? And is there a way to alleviate the overall pain, potentially by partially transitioning to like a Bitcoin economy or something like that?
Yeah, I mean, I think that it's hard to predict, and I'm not someone that's an ultimate doomsdayer that we're going to go back into a 2008 like crisis. I think what I am confident in, and what we're already seeing today, is that the Fed's response is and will increasingly become QE, and QE a lot quicker and a lot more accommodative a lot sooner. And so I think that Bitcoin really exists because of QE. Whatever you want to call it, today the Fed is unwinding the balance sheet. They're quickly going to reverse that. They've already signaled that they're going to be reversing it, or at least stopping the shrinking of the balance sheet in September of this year. But the ECB hasn't stopped, and the Bank of Japan hasn't stopped, and Bitcoin is global, and Bitcoin really is the antimatter to Fed's QE. I think the best case scenario is that we gradually shift or gradually onboard enough people to have a sustainable Bitcoin economy at the time when an actual developing world's currency
just tits up.
Yeah, couldn't say it better. Wouldn't have said it, but a G5 currency actually hyperinflates. It's one thing to see, and again, it's incredibly devastating to see what's going on in places like Venezuela. But when you don't have an alternate currency system, and that's really what I think of as what Bitcoin is, it is that backup. Without Bitcoin, money, and again, this isn't these are views that I formed by reading things from Hayek and people like Safe. It's really the backbone that allows people that don't have any incentive to otherwise cooperate or coordinate to specialize and to have a division of labor that allows them to go and create things that they wouldn't otherwise be able to do. And it's really what creates basically a civilized society, the ability to do that. And so my hope is, my expectation is, at least, kind of in the next cycle, we're not going to, the dollar's not going to hyperinflate through the next round of QE, but that people increasingly pay attention and that they realize that Bitcoin exists because of operations like QE.
How do we get people to stop watching The Bachelor and start thinking about what money is and the fact that it probably needs to be fixed? So that's like the mission we're on here on Tales from the Crypt, and that Marty's been, is to try to educate people that, hey, maybe you should think about what your money is and how it affects your life and the life of your family and everybody that you share this world with. And I'm just interested to hear your opinions of the best way to go about educating people, or maybe like nudging people towards maybe thinking about this, Well, or is it something where they don't think about it till they're forced to?
No, I think that the people who have more access to knowledge are, I don't want to say unfortunately, but the people who are in the less dire needs have more access to information, so they're gonna that knowledge is gonna transfer them sooner than the places where it's needed most acutely today. But I can certainly say that the answer isn't to airdrop Zcash to people. Like, you don't want to airdrop not money to people that need money. But I do think that the best way, and I spend an incredible amount of my own time explaining Bitcoin to people. I'm not a developer, but I think I understand the problems.
You have a very good grasp of how the protocol works.
Yeah, and that is also another thing, that once you read the Bitcoin Standard, you read Mastering Bitcoin. I just got Jimmy Song's new book, Programming Bitcoin. So one of these days I'll build up the courage to actually work through and understand elliptic curve math better.
Are we going to see a Parker Lewis PR in Bitcoin Core one day?
We better.
if you're reading all those books, that's what I hope comes out of it.
If we don't, I've taken a wrong turn. But I've got to. There's going to be some time. I need a decade at least.
There's going to be some important pull requests that we need in a decade. So
yeah,
start one day at a time, one page at a time.
But so, I mean, realistically, I think that the best way to do it is to educate people on why private keys are so important. Educate people on what Bitcoin is, like what money is. I think that's the best thing about Bitcoin. People are just going to have, again, when we were kids, when I was a kid, I never stopped and asked why the dollars that my dad gave me for doing a chore. My first job was bussing tables at a Mexican food restaurant in Austin. You never stopped and asked, why is this dollar bill money? And I think that's the best thing that Bitcoin is going to force people to do, partly because it's interesting. And earlier on, it's not going to be necessarily forced, but people are going to be increasingly interested in just understanding what money is. And so what I do today is, and what my good friend Gideon Powell down in Texas does,
Shout out Gideon.
We buy a bunch of copies of the Bitcoin Standard. Again, I can't, what I started to do, and thank you, Safe, too, is if people have to have a willingness to want to know, because otherwise you're just talking into a brick wall. But once somebody's intellectual curiosity is piqued enough to go read 300 pages, then I tell them, I'll answer any question that you have, but here's the book that sets a baseline, and once you have questions off that. But education is just a slow process, and I think in my own experience and everybody's experience, people come to unlock those mental blocks in different ways. And so it just takes time, but also recognizing that people don't have 2 years to stare at this, and that I think that was something great that Square did when they came out. Again, it was only a 10 or 15 page
little children's book.
It was just a little children's book to try to educate people on what Bitcoin is and what it isn't. Again, it's more the interest and being invested in the space is that education's a piece of that, and that more people need to be doing it. There's guys like Michael Goldstein and Pierre Rochard that aggregate information at the Nakamoto Institute.
Couple of fucking legends with an incredible website there.
Yeah, those guys, a little bit of a rough crowd, but they'll educate you.
They'll educate you, and they'll be funny while doing it. Shout out Pierre and Michael. You guys have the best snark on any platform that I've ever.
Those guys can chill on Twitter.
Yeah,
like nobody's business.
Yeah. U.S. dollar's down 16% today. If you didn't realize it,
I actually saw that because Bitstein tweeted
it. No, that's one thing you realize when you get into Bitcoin, though. It is like intellectually stimulating, and again, this is something I harp on this podcast, is like money is one half of every transaction that you make in the world. It's a very important tool, potentially the most important tool that we humans use, and it's important to know what it is. And I think what you did with Ender's Game and your knowledge of the Fed and trying to spread that understanding of what they're actually doing and their misunderstanding of what they're doing is very helpful to leading people to the question of first asking, all right, what is money? These people are fucking this up so bad. What are they fucking up, and how is it fixed? So
right, and it's not. I think that one of the biggest misnomers is that it's a collective hallucination or
no, it's a tool.
It's a tool, and it's also, I think Pierre talks about this. Probably his definition is probably the best. It's a social consensus. Mm-hmm. We are identifying.
But people get social consensus and collective delusion. They intertwine those and make them interchangeable, but they're not.
Yeah, and in my view, it's not a hallucination. Safe does a great job of talking about this in his book, where he goes through the history of money. And one of the things that I took away from it was that, whether it was rye stones or seashells or glass beads, and I know that he relied on some of the writings of Nick Szabo, is that it was always some form of technology that led to the demonetization of something else. And so the way I think about Bitcoin is we're using the technology that we have available today to demonetize gold. Gold had, again, these aren't my own original thoughts, but it's something that I leveraged to better understand Bitcoin. I was reading Safe, is that gold had its limitations, and Bitcoin really tried to solve the problem of money, but also how to build on the flaws of gold. And the principal piece of that was, how do I create this in a decentralized way? And gold was very susceptible to being centralized. And so, again, it's not an easy thing to understand, and it takes time, but education is a hard process, and people just have to relate it to both their own experiences, their own real life experiences, with access to knowledge.
Yeah. No, your comment on like the bastardization of the cold standard reminded me of somebody we've been talking about a lot this podcast, is Hayek, with the only way that we'll ever be able to fix money is to take it out of the hands of the government in some sly roundabout way. And Bitcoin is that sly roundabout way, I would say.
Could still fail.
Could definitely still fail. But it is a sly roundabout way chance that we have and are actively working on.
Yeah, and it's really, I think, our best chance. And there's another quote that it was a book that Roy Sabag, the guy who founded Gold Money or BitGold, steered my way, and it's a book I don't even think is in circulation anymore. I had to go and buy a used one on Amazon for like $90. It was called The World in Debt. But there's a quote in that book that has always stuck with me, that talks about how the reliance of one man's trust and another man's promise is one of the slowest conquests of civilization. And it's this idea that while decentralization and taking away a centralized party's ability to create money, and that money is really best dealt with on the free market, and that the reason why Bitcoin works is because it's decentralized and because it's censorship resistant, is incredibly important. But there's a whole amount of disinformation out there that we're now going to decentralize the world, and that trust is actually not a bad thing. It's just a really bad thing when it comes to our money. And we've learned that through history, but again, not a lot of people have figured that out, and that going through the process of understanding money and understanding Bitcoin will be core to people having a greater appreciation for that.
No, this is something that Tom Garenbaum brought up last week, and that is actually something that we should always think about when trying to apply these systems to the way they fit in our world. Like Bitcoin as a money makes sense as anarchy, like governance via anarchy, because it's a global tool. Whereas if you're trying to reallocate to a community, a local community, maybe like some socialistic tendencies make sense on like a local community level. But when you try to scale that up from local to state to country to global, it just doesn't work. And trying to figure out which schemes, whether it be decentralization with Bitcoin on a global scale, makes sense for money, whereas centralization on a global scale, we're finding out in our current monetary regime, may not be as advantageous.
Yeah, I think people having ownership of private businesses and ownership of private property, and again, when you think about the complexity of supply chains, and basically if you thought about very complicated supply chains and ones that involve capital goods, a lot of companies rely on other companies to provide them high quality goods and materials, and they rely on those partners in a trusted way, and that's inherently a good thing. Like, you want people to have ownership economics and to specialize and to have divisional labor. That's essentially what money allows you to do. And so it's that idea that decentralization and censorship resistance is a really important quality in money, but that everybody also needs to understand that we don't need to put beef on the blockchain, or so long as Dropbox is a reliable, partner in, creating, centralized file storage, we don't need to have a decentralized file system. Now, are there other ways or, things that need to be decentralized? I think so, but a blockchain isn't the solution for those other applications. The blockchain was a specific data structure that allowed us to decentralize money, but not beef.
Yeah, so if you're out there trying to blockchain the world, just take pause, think about it, think critically about it, and
get back to first principles. Read your Hayek.
Right. So again, let's end it on first principles. First principles are important. They're imperative. I think a lot of people outside of Bitcoin in cryptocurrency do not have a solid first principle mindset. I would argue that Bitcoiners do, and this is exuded in the conservatism through which the development team works, and then through which the advocates work, and trying to condense the message into something very simple and understandable. Parker, it's been a pleasure. We're an hour, 21 minutes in. The temperature has fallen about 15 degrees since we've been sitting up here. The sun is gone.
It went to Chile to reminding me why I need to get back to Texas. So got a flight back to Austin. When you guys are in Austin, come and visit us.
I can't wait to visit. Do you have a parting note for the freaks? Anything you want to let them know?
Give out the Bitcoin standard. Help educate people. Check out what we're doing at Unchained. Read Safe's book. Anything that you can do to help create value in Bitcoin or promote Bitcoin, I think, is a positive thing. And look forward to seeing you guys all in Texas sometime soon.
Well, I look forward to making it down to Texas. And Parker, thank you for what you do. I'm a huge fan. I've learned an immense amount over the years from conversations with you, and I'm very appreciative for your company, as always.
All right, appreciate it.
Peace and love, freaks.